Okay, this is just a bit of an update. I ran across, I had a watch on Griffin Corp, and they make like home, like home organization equipment, like those closet-made wire shelves and stuff like that. I'm not going to go into too much detail on what they do, because that's not. Because the interesting thing here is that it came up on my watch list. I went to Fastcrafts, noticed that the price had been going down and it's well below sort of the historic PE ratio. And I have another video on how Fastcrafts works, but the idea is that they look at what the market has valued that company at in terms of PE ratio, and then they say, well, based on the earnings right now, what do we think the price would be? And that's this orange line, or maybe the blue line, depending. The orange line is a PE ratio of PE to growth ratio of 1, and the blue is what the normal PE ratio is. So this price is well below the historic PE ratio. So looks like it might be a buy. And I went and looked at Simply Wall Street. Got a great yield. It's well covered by the earnings. Most importantly, it's trading well below its intrinsic price. But the really interesting thing is I went and looked at so I had purchased GFF back in, and this is when I first started using Fastcrafts. Fastcrafts recommended a buy, or it looked like a buy, on 12 of 220, and then it looked like a sell on 4 of 221, about 5 months later. So I thought, let me go and see how I did with that. Well, first of all, it did pretty well. I made about a 40 or 50% gain. Let's see, about 35% gain. And in 6 months, which is 70% a year. So I went and looked at this, and I said, okay, so I bought it in December 23rd, which if you look at the graph here and see where it was December 23rd, it was right about there. Okay, right there. It's kind of hard to see, but it was, if you can see that little black dot, it was below the orange line. So Fastcraft said, hey, this is below its historic PE. So I'm like, great, I'll buy it. And I might have waited until it was going up just a little bit. And sure enough, it continued to go up, continued to go up. And then Fastcraft said, you know what? It's a little overpriced. So I sold. And sure enough, it went down, went back up again. And up here, it was just above fair value. Now it's gone way down, and it's still going down. So PE ratio of 9.6, which is well below the historic. And if it were to grow at the same, continue at the same earnings growth rate, which is, jump over here, it's projected to grow at 18%. So if it continues to grow at 18% and it returns to its historic PE ratio of about 20, I'm going to estimate below, we'll go to 19.8. Fastgraphs is projecting that with dividend gains, it'll earn 60% a year, which is actually pretty close to what I got before. I made about a 30% gain, but that was over about 5 months. That'd be 60% a year. Now, I went in just for giggles and also looked at some other things. Let me show you what I found. So first of all, we're seeing that Fastgraphs, for this stock at least, seems to have pretty accurately predicted when it was overpriced, when it was underpriced, and then it was overpriced, and now I'm looking at it being underpriced again. So I am going to show you so this is my past. I keep track of all these stocks. That's why I knew where I'd bought. So let's look at what's going on with it now. So we showed it's undervalued 80%. You saw that. Earnings growth is 33% roughly per year, anywhere from 18 to 33. And you can see here, this is from Wall Street Zen, and they're looking at 123% over 3 years. So that'd be roughly, call it 35% compounded. Revenue is increasing, although it's starting to level, but earnings are increasing. That's great. Simply Wall Street pegs it at, well, this just shows the kind of the trend, but the actual number is here. They're saying 32% for next year, but leveling off a little bit, which is fine. And it's got a 2% well covered. The 2% roughly dividend is well covered. The white line down here, well below free cash. Oh shoot, that's adjusted earnings. I wanted to do that as cash flow. Okay, so here's the cash flow. White line again is the dividend down here, and free cash flow is, I believe, this orange one here, and you can see down here, it's kind of small, that the dividend is a percentage of free cash flow. So well covered. And also Simply Wall Street also reports that the 1.9% dividend has been steady and that it is well covered by earnings. So all in all, looks like a buy to me. Obviously, this is for information purposes only, but I am planning to invest because I think it looks like a good deal. Thank you very much.